No, it's all good. Okay, cool. Cool. Sorry about that. Yeah, sorry about that. Okay, let's keep going. I wasn't sure. I had to make sure this is just up and running properly. Okay, so first things first is support and resistance. I believe this will continue just where I left off. I'm not sure if it's gonna add or whatnot, but we'll pick up where we left off. So let's just go to a major chart, AU. Okay, so first things first, like I said, we're focusing on risk to rewards on our trades. I'm not going to take notes on this. But you guys should definitely take notes on this. And then apart from that, this is going to be recorded so you guys can go back through. I talk a little fast when I talk about Forex or trading because I'm really into it, but I'll try to stay slowed down a bit, okay? I just want to be able to see your comments if I can. Sorry, just a moment. Okay, beautiful. Okay, so support and resistance. So we have the three cases, the three types of entries that we can take. Basically, candle close. If I can just zoom in on one of these, let's go down to the 4 hour. Let me delete everything. Okay, so I believe a lot of us, there's probably some new people I shouldn't judge. We have candle closes and we have open candles. Like the current candle right now is open, and let me go to a cryptocurrency real quick. Cryptocurrency will show me the time right here. So there's 2 hours and 19 minutes before this candle will close. So if I decide to ever act on a candle like this, essentially I'm judging it. It's not complete. So for me to say that this is a red candle right now would totally be false, because it hasn't closed that way. I'm sure a lot of experienced traders know that there's been times where a candle might have looked red and you went to act on that, and then by the candle close, it's probably a very strong bullish candle. So that's one thing that we need to take into account for. Candle close, three things: candle close, and then trading from the actual zone, so taking your trades on active candles right at the zone, and then the other thing is focusing on re-entering the market. So whether that's in a case of a failed trade or in a case of just a trade that's going our way and we want to try to capitalize on this and increase, basically compound and add more positions in. These are three types of entries, which maybe I'll just try to those are three types of entries: candle close, enter exactly at the zone, and then looking for re-entries. That's the three that we're going to cover right now. And basically, let's just go through and mark this up real quick with some support and resistance, essentially. Okay, so we're on the weekly time frame. Like I said before with the things in the trading plan video, the first webinar we did, it's very important that we have the general trend, and then you have the main trend, which you trade inside of. You trade in the direction of the major trend. Okay. So let's go through and do this. We can see a few things, and we're also still applying market structure, all those things from the first video that we covered in the webinar. But this one more so just on the entries themselves. So in a case like this where we have higher high structure being formed, okay, we don't doubt these things. We literally see higher highs coming in. Okay, this is support and resistance. So we have a price like this where price went up, stopped going up. We don't really have to care why this happens. There are thousands and thousands of reasons why things are happening, and the reasons why are basically unquantifiable. It's the type of thing where you would go insane looking for all the reasons why XYZ happens when there's too many reasons, when there's essentially too many reasons. Okay, my trading is basically just focusing on the fact that this had happened and the fact that this presented an opportunity that we can actually take a trade from. Okay, so the fact that we can see price go up, stopped going up for who knows why, but then also continued up, forming higher high formation. The way I learned things were trends are always going to continue no matter what, unless they stop. So trends continue ultimately until they stop. So that's the same that's the same idea that I go with when I'm taking my trades. So seeing that this was a resistance area, and I know old psychological resistances will turn into supports as well. We all know support becomes resistance and resistance becomes support. I must go over this just like this because this is the essential to actually taking the trade, okay? The fact that support becomes resistance and resistance becomes support, but this isn't just to horizontal support and resistance, but moving averages and Fibonacci's and things just like that. But we'll touch into those ones when we actually touch on this. This is more just for support and resistance, the way I do it. Okay. Okay, so this is the general trend. We're on the weekly, as we can see, right? We can see that right here. And I want to mention this as well, that the pair that we're looking at doesn't matter. Not in my cases. Each pair is, my method is transferable from all markets. I've been in many markets where I'm just applying the same thing. It's not like this market requires this strategy unless that's what you prefer to do. I can't stress that enough. Everybody has a different working schedule, or some people can't trade while they're at work, or certain people can't do or feel like they can't do certain things. So you must allocate the time to perform your trading or whatever when you can. Okay, so whether that's investing and you want to be trading twice a year, 3 times a year, then that's what you should be focusing on. Okay, not because you see a scalper do something else means you need to copy him. Okay, but the general idea here is that we got a higher high structure. We need higher high structure to continue if this trend is to continue ultimately. So if price had broken through, then I would have just lost these setup trades, which we'll go into more detail how to actually take these trades, but I would have just lost the trade. I wonder if you guys have seen the picture where, price is making higher highs and you're like, okay, these are good buying opportunities. But then once price actually breaks structure, you say goodbye to the trade. The trade is no good no more because now we're not continuing old ways, essentially. Okay, so this is one of the major factors here, is that we have a higher high structure and we're currently sitting at the support, in this case right here. Okay. So the next key factor here is that we actually get a bullish candle next, okay? We get a bullish candle right there. I'm going to mark up the next week because that's the start of that week. Yeah, so that's the start of that week there, basically. And we can see a few things. We can get the idea that the old trend may definitely continue because one, we've come back into contact with the support, which is our area of interest. This is our key area where we look to take trades from. We're not taking trades from up here. We're not taking trades from just above this zone. Price has to interact with it, has to at least touch it by a wick, has to at least touch it by a body, but it has to interact with this zone for me to become on alert, to be like, okay, something may happen here. And the next confirmation that I'm looking for in these cases is just a bullish candle to tell me that buyers have come in. I'm not going to doubt green candles and say that means red. I know a lot of people do that stuff, and ultimately it's just you have a lot of people that are uncertain of the course of action to take. But in this case here, we have buyers have come in at the floor area. I often describe support and resistance to be like going through an apartment building with a ball. Certain times price has enough momentum to break through the ceiling, and then once it's up on that new level, it's now a support, and the only way it's going to get back through is if it has enough momentum to go back through. But it's always just like price is like a ball just bouncing through bouncing through in a building. So in this case here, price had broken above the ceiling and it's fallen back. My first indication that I want to take this going up to the next ceiling and maybe higher, because we expect trends to continue, is the fact that buyers have come in by that green candle. Simple enough, okay? So let's just go down 2 time frames below, 2 standard time frames below to the 4 hour, where the same thing basically applies. I'm only looking to take trades bullish, like buying trades. The case never comes where I'm looking to do the opposite of that, unless you're trying to counter trend trade. But in these cases, that's not really what I focus on for like trading like this. Okay. So essentially the same thing. We know that this line is where the week begins, and we had that bullish candle, that bullish rejection of the support, tell us buyers are coming in. I don't know how long it will take to accumulate all the rest of the buyers, or things, or when price is going to be super duper ready to move. This is why I don't apply time limits to my trades or anything like that. I simply know that a setup has appeared and I'm willing to take that opportunity. And like I said, we're going to focus on risk management in this, or not risk management, but risk to reward. And that's basically what, after I get my opportunity, this is what I want to focus on to get good risk to reward trades. So basically the same idea appears where I had let me just go back to the weekly. Okay, yeah, so we have, I need to speed this up. Yeah, so we have the resistance that breaks through and comes back to the support. So we're still applying the same support and resistance, support and resistance idea to the lower time frames. And you can see I drew my resistance here from the candle close to the wick high. It's always candle close to the wick high, but another factor to this is that you must apply your support and resistance to areas that you can work with, okay? So I would never apply a support and resistance zone like this from this candle close to this wick low, because this gives me a zone that's way too thick. I can never place a trade like risking just about 300 pips. Personally, my stop loss limit is about 100 pips, but still at 2%, or it depends on what I'm doing, but just about 2%. And so you just need to manage your risk, understand the percentage, but also the pips, okay? And then that also goes into dollar. Make sure you're risking a dollar amount that you are comfortable with losing by far. Like, you must always consider your risk before you consider your profits in all cases. Okay, so here we have our resistance turn support, and then we go down to the 4 hour time frame where we want to see the buyers come in. We want to see, we want to have confirmation that what we've seen from the weekly is actually going to happen, is actually happening, for a matter of fact, because we should get higher high structure, which is uptrend structure. We never doubt that. Okay, it's like when I explain the river flow. The main trend of the river is downhill, but not every flow in the water is going to be downhill. A majority will be, but you do have sometimes where the flow of the water doesn't go with the direction of everything else. Okay, so I go to the same time frame. I use previous information on the left to determine market structure, the hiccups, the psychological, the areas of psychological difficulty in price. Okay, so we have one area there where we can basically see there is the wick, correct? There's the wick, and then we also have a low down here, and we also have this area around here, right? And ultimately, all we need to see is higher highs trend structure come back in. This is the same thing I basically posted in the TPA 2.1, which is available on YouTube until like Monday, I believe. But it's the same case. You have setups where you see buyers come back in only at our support and resistance areas. It's never going to be in between these zones. And it's the same thing for the random replay trades that I'm posting on YouTube at the moment. it's the same type of setup. So I hope that this can explain, make those make more sense as well. Okay, so this is the case where we take trades based on first is candle close. Here we do have a bullish candle at the support, right? You could try to take that trade, and we need to hold ourselves to a certain standard. Do we want to be risking 1 to gain 2 on all of our trades? Do we want to be risking 1 to gain 3? But I would definitely say risk 1 to gain 3 or more, okay? Risk 1 to gain 3 or more. We'll probably run into some better examples. Let me do it like, yeah, okay, hold on. So let's go to today's date. So same way that I was going through and drawing my support and resistance zones, how I drew this one here, price made a high, I marked that one off, and it turned into support. Same thing goes for right here. I need to do the same thing. So like I said, how trends should continue. If trends are continuing, we have to first run into the previous high. This is our first area of conflict, okay? Because it's an area of conflict because what did we do last time we were there? We rejected it, right? So the same thing goes. This is our first take profit area, or you could do 1 to 3. You have many options. This is why it's important to know what is actually a part of your trading plan, okay? So in a case like this, our target can be the next resistance, and our stop loss must go on the other side of the zone. Your stop loss needs to be at a place that proves your analysis as wrong, okay? It's not at a place where, okay, I only want to lose $5 on this trade, so that's where I'm gonna put it. Okay, your stop loss needs to be like, let's say like a percentage loss. So you're like, I'm willing to lose 5% on my account. So that's where I'm gonna put my stop loss for 1. But on top of all that, it must be at an area that proves your analysis is wrong, okay? This is why I always be placing my stop losses on the other side of the zone, so I can be clear and understand that if my stop loss gets hit, price is not making higher highs, right? And I need higher highs for things to go my way, essentially, right? And no matter how much I lose, no matter how much the trade goes, hits my stop losses in these cases, I'm not switching my bias to take short trades because the weekly is already up. The weekly is up, so that's all I'm trying to do, okay? So let's just go through and show like this. We have a loss, about risk 1 to gain 6 essentially, which is a failed trade. Here's another case where we actually do pop back above the pop back above the support and resistance zone, stop loss on the other side of the zone, and this one our TP still doesn't get hit, okay? This I'm not going to go into detail on this. This is probably the longest one, but I'm not going to go into too much detail on this, but it's the same case where you can manage your trade. So you need to know, like I have different students who would do things like after 10 pip gains, they would try to take out some. After 100 pip gains, they would like move their stop loss to break even, or because each of them have like their own work schedule, so each of them can't be at the market 24 hours a day. So you must be using a trailing stop system, which I cover in the first webinar as well. Okay, so it's just understanding how are you going to be managing these trades, but you got to understand as well, do you want to be taking your trades at the candle close, or will you be focusing on things like, okay, so this one goes through, hits its stop loss, but when we have a situation down here where we've come back to this zone, okay, the weekly zone and all that, you could be trying to take your trade just as price comes into our zone, but your stop loss needs to be predefined as well, okay? So whether that's going to be, like I said, it's always on the other side of the zone. If you want to be on the other side of this zone, that's something you can do, but you need to keep your risk to reward ratio intact, okay? Stop loss, take profit, others, the next resistance, same way it's explained in the PDF course, stop loss all the way down here, okay? Let's, essentially, okay, stop loss down there, but I want to, yeah, so this goes through, hits its stop loss, great. Okay, same thing happens no matter what. Here we have a few losses where we would do about lose 2%, lose 2%, lose 2%. And then we would go in when we see another setup. They're always going to be the same setups in the same direction. Okay, here we have another green candle, and all the green candles tell me that buyers are coming in at the support. Okay, if price is not at support, I don't care about green candles. If price is not at that area of key interest, I don't care about what candles are being formed. Price needs to interact with that zone to signal me ultimately. Okay, and then same thing goes, stop loss, other side of the zone. Take profit can always be the same. Okay, so in this case, it's risk 1 to gain 5. I don't know the math, but if this was risk 1 to gain 6, I believe this would break even on all these other trades. Okay, so you got to understand that, like, it's not always going to be this trade has to be won, this trade has to be won, but you're averaging. Trading is definitely an averaging thing where it's like, okay, my set out of 10 trades or my set out of 100 trades. This is why I went into detail on the last webinar to get a sample size to understand how will you be, what are your results, so you can understand, okay, do I need a better risk to reward ratio on my trades, or do I need to filter out some of the trades because they're just poorly taken trades? But let me continue here through where we can see higher high structure continues, which is with the major trend. And we've also popped above the major resistance from the weekly time frame, this line here. So same thing goes. It's always green candles that support, like always that. Okay. There does come the case where we did pop above, and then you could, because I was taking trades like this in the Telegram, I believe around June maybe. Basically the idea behind that type of stuff would be, price did close above our area, and the other factor was that, so price closing above the area is a breakout trade, which a lot of traders know. You could take entries from these type of things as well. I want to do it like this. So let's say our target was right there. Okay, our target was, I need to think this through real quick. Let's do like 1-to-1. Okay, does this make sense? Trying to see something real quick. Okay, I can actually after this example, I'll go through and show you exactly what I mean. Okay, but the same thing goes here. We're still green candles at the support where you get one there. You get a little bit of drawdown as price drops down, basically. But price as a whole stays above the weekly support. And the same thing goes for what I was doing over here by drawing support and resistances on the 4-hour trade, on the 4-hour time frame, to go in trend with the weekly. The same thing still goes for cases like this where, let's say, the new week starts here. Let me see when the new week actually starts. The new week after the breakout starts right here. So we got a retest of that, I can see already. Yeah, okay, it started right there. But the same thing goes using the psychology in the week of the week before, the market structure and all that. You would draw your support and your resistances, your areas of key interest. Okay, so if price can drop back to these areas and form bullish candles like this, I know I can take a trade. You could take a trade on a open candle, a candle that's not closed yet, which we kind of discussed earlier, just like this. But you got to know where your stop loss is going to be. Is it going to be on the other side of the weekly zone or anything like that? But these would just be early entries. The only reason you can really take the early entries is because you have your your major trend already set. You have your major trend already set, and price has already come into contact with your support and resistance zone. The only thing that you're basically missing by taking a trade based on a candle that is currently active and not closed yet is that you don't have confirmation, okay? But your risk to reward, like I say always and everywhere, is that these things already have to be predefined, okay? So there we have like a risk 1 to gain 3 ratio, and that is something I hold myself to. Risk 1 to gain 3 or more, and then from risk 1 to gain 3 is where you can then choose to move your stop loss to break even. Do you want to close your trade? Do you want to close half your position? But you have multiple options of different things that you could try to do, okay? Yeah, okay, so we have that, okay? Support and resistance is honestly, that's how I go about doing it. You have resistance, you have, well, in these cases here, since the major trend is up, I'm not focused on resistances, I'm just focused on supports. I will totally let the trend go against me. I would totally let the trend go against me and prove me wrong for that week long before I would go through and redo my bias to go in the direction of the always stay in the direction of the weekly time frame, or the time frame that you're the general trend time frame that you're looking to trade from. Essentially that's how it goes for support and resistance. And it's the same thing for price action, to specify that green candles mean advancing, go, everything like that. You're only taking your trades from these support and resistance areas and not anywhere in between. You're not taking your trade. If I can show an example like this. Okay, so you see this area here actually, and we go to the 4 hour. Okay. My best opportunities are obviously taking trades from support, the major support, to the major resistance. If I'm looking to take trades all throughout in here, like let's say, the psychological fears and everything that's at place. If I take a trade all the way up here, sure, the trade could work out, but my risk to reward gets smaller. Okay, sorry, just a moment. So basically, the end result is that you have your risk to reward gets worse, and we want to focus on getting a good risk to reward. The main basis behind getting good trading is having good psychology, a good understanding of what you're getting involved with, whether that's to the losses, to the profits, and then not only losses and profits, but what are you doing in cases where you're probably not trading? Are you supposed to be sitting on the sidelines? And then having a trading plan, of course, and then there's risk management, which this has to do with it. You need to be keeping your losses small. There are a lot of traders who want to do high risk trading and things like that, but you just got to understand the risk profile nonetheless. So it's best to take the trades from the support, the major supports, to the resistance as close as you can, but understand that you have a lot of traders who get the fear of missing out, who would take a trade all the way up here and maybe not even place a stop loss, or if they place a stop loss, their stop loss is really wide while their take profit is very small, which is not something that you could do. Which is something you can do, but you won't have the most success in that. You must keep your losses small, try to reduce your losses, and never extend your stop losses type of thing, okay? Let's move on to and basically, this goes to for re-entries where we took multiple losing trades, and then we're ultimately still waiting for the bullish trade to come through and put us in our direction. Okay, cool. Okay, so everything is going to basically go in with multiple time frame analysis. Like I said, grabbing your trend from the higher time frame and then coming back to the lower time frame to trade in direction of that. Okay, so even though price is at the major resistance here, this doesn't mean we're looking to short, because the weekly is still on the uptrend. Okay, so that's basically how that goes. And then the next thing is moving averages. We have a lot of traders that use moving averages, and I go through and apply them essentially in like the same way. Okay, now the moving averages that we choose to use aren't necessarily that important. These things like the indicators and the time frames, these things are more so to produce opportunities at a rate that works with you. Okay, if we use something like, let me just actually delete these. Let me put on some other ones. I want to put on the 9, the 50, and the 200 for no specific reason other than I know that a lot of traders use these numbers, and these numbers will give a good yes, for all market types. Okay, so this one here is the 200, and basically it produces opportunity at a slower rate. Okay, it's supposed to produce opportunities at a less is more type of thought, where it produces less opportunities but better opportunities. Okay, because they would be giving good risk to reward ratios on your trades, because when the moving averages, we'll look at it when I just finish sending them, but the moving averages will last really long, the higher the length, the period. So we have the 50, and let me change this color to like black. Cool. Okay, so this blue one here is the 9, and then this thick black one is the 50, and then this yellow orange one, whatever you want to call, is the 200. So basically, okay, so basically if we just take the time to look at this, let's go from the weekly as well, because it's the same top-down analysis, same multiple time frame analysis that applies. We have the 200 being the largest length. Okay, so anytime that price is below, it's really as simple to take trades below, and your stop loss on the other side of that that moving average. You don't expect that moving average to get broken, because that moving average is your support and resistance, should be like the law essentially. Okay, I'll just go through the questions at the end. I just really want to focus on this and make sure I get this done in a timely manner. So essentially, when you're using the moving averages, the same thing applies. Stop loss needs to go on the other side of this zone, because you expect your moving average to hold, right? That's part of your trading plan if that's what you're doing, and you expect these things to hold. But you got to understand that at these areas of support and resistance is where you often face a lot of consolidation, as price has returned to an area where, it's a good way to explain it. When price goes back to its key area, its area of opportunity, you often get a lot of consolidation there, because that's where a lot of other buyers are letting go of orders, losing orders. A lot of traders, just like you, are getting into the market and getting stopped out before the trade actually goes in the direction that they originally thought. Okay, so normally you do have that push and pull. Yeah, we can call it like the rubber band effect, where price goes off into these long runs, and we would call these trending markets, and price goes to the consolidation markets. Okay, where price just goes through and produces opportunities that are essentially not profitable, or they range. We call them ranging markets. Okay, these are type of things. As price is above, your stop loss needs to be on the other side of the zone. There's no point in doing things like this and not having no take profit area. Your take profit and your stop loss must be predefined, and you must have some general idea to where you're going to get into the market before actually placing the trade. and that's covered more in the first and the second webinar as well. Okay, but let's hold on, let's go on another chart. I believe in more charts I get better examples. Okay, so the same thing would go, we're on the weekly time frame. If I can just go like this. So here we can see something where we got all this rejection and stuff, and we actually popped above the moving average of this week here. And I'm gonna mark off this week to show that this was the red candle rejection, and then we popped down to the lower time frame, because top-down analysis is still the play that we're working with in all cases. Okay, so when we have things like this where we know our first vertical line is looking for short opportunities, that's all we look for. We need a red candle, same thing, back at the moving average, but we don't even get, so we never even take a short trade. But if we wanted to take the trade on the open candle, the candle that hasn't closed yet, we still need a target area for this, or depending on how you're moving the average, do you want to just trail the moving average and wait for something like this, where let's say you can enter right here when price pops above, and you're looking to exit when price goes back below, that type of thing, because there are those traders, or maybe this is a better example, entering there and exiting when price gets back to on the opposite side, because that's more like trend following. Okay, so yeah, that's more like trend following. But the same thing goes, you could try to take a trade on this open candle. Your stop loss must be predefined, and definitely have some standards for yourself. You're not taking one-to-one trades all the time. And this is worth mentioning, that understand your sample size. Okay, what is the trade by trade result? Like, is this a trade a win? Is this a loss? Is this a win? Is this a loss? Because if you're taking risk 1 to gain 1 trades all the time on your trades, you need to get above a 51% return rate to make money. Like, you need to get above 51% to make money in these cases. So for a trader, like, let's say getting 30% return rate, so out of 10 trades they're losing 7 and winning 3, all that you really need to do to increase something like this is take better risk to reward trades, reduce your stop losses, and increase your target. So risk 1 to gain 10, risk 1 to gain 5, I believe the ratio of risk 1 to gain 5 completely negates the negative effects of losing, having a 30% return rate, essentially, right? So same thing goes for moving averages. So that's a case for a trade where you didn't get confirmation because you didn't actually get the red candle rejection. But the second line here, where we know we popped above the weekly moving averages and we're looking to take trades to the upside, everything that we take is just gonna every green candle that pops above the resistance or rejects the moving average is an opportunity to take these trades. Okay, risk 1 to gain 3, whatever standard you want to hold for yourself. Do you want to just hold one trade at a time, or will you be one trade at a time, or will you choose to stack them? Or one thing that I used to do as well is you would go through and like track the trend, right? So here we have an opportunity, well, not an opportunity, but some structure. Okay, and the structure starts to stall and we actually break through. So you could go through and like add positions when price pops above the moving averages. Understand that your stop loss needs to be on the other side of the moving averages, just because your support and resistance shouldn't break if it is holding. The only other time that it breaks is when there's like whipsaws, or I believe we call them kangaroo tails, when price basically snaps through. Is there an example of that? When you get large wicks, and like basically it stops through your price. But nonetheless, these are these whipsaws. You can still find reason to enter as long as there's another setup. Okay, But the same thing goes as long as higher high structure is being formed, and this is for compounding, you could definitely just be taking trades below the structure. And I want to add this too, that the reason why I don't really go through and use the moving average, and why I would rather prefer to use actual market structure for my support and resistance and my stop losses and things like that, is because you have cases like this where the consolidation starts to pick up in the market with the moving average, and you start getting a lot of different signals. But mind you, we've already cut out a lot of the false signals by just going with the major trend, just going with uptrends. So all of these are only bullish opportunities, and you're never taking short opportunities. Even in this case here, where price is falling, these aren't trades for you to take. You need price to be above these moving averages to take trades in that direction, because the same thing applies for this here. Let me just... The black EMA is the, I believe that one is the 50, the 50 moving average. Yeah, and like I said, none of these are super duper special, but what these do for us is provide us opportunities at a certain rate. Okay, so this one here, this blue one being the 9, is going to produce way more opportunities than the weekly. So the reason you got to consider something like this is your schedule. Like, how often are you at work, or how often you're just busy with other things? How often are you just busy with other things, and how often can you be on the charts watching it and trading it, but also still not doing over trading? And I wouldn't say, we're going to touch into Confluence right after. I don't want to take up like your whole day. So let's just keep moving. Okay, so that's basically, you can see the similarity between this and how I trade based on just using horizontal support and resistance. This is this moving average is another version of support and resistance. This is why in the first webinar I went on to say, like, you need to have a what do you call it, you basically need to have a reason to like define this is a low price and this is a high price. Okay, so when I use the horizontal support and resistance, I know that if price is above this area and interacts with it, this should be a low price. So the same thing goes here. As price is let me zoom out. As price is below this black area, I know that anytime price interacts with this line, that this is considered a high price. Price needs to be ultimately like way below. Okay, same thing goes. Let's see if I can touch on some other charts. Same thing goes here, and so this is a great example. But I'm going to touch more on this type of stuff later. But like, this is more so Confluence trading, where I've already put in my support and my horizontal support and resistance, and that's basically my focus, what I'm really using. And apart from that, we have the 50 moving average that's in there, that's also acting as a resistance, right? It was a support over here and it couldn't hold and it broke through. The same case goes, you can always be taking trades. Let's show this one. I don't really want to delete these. Okay, so we have this red candle rejection, which pops back below the support and resistance that we have there. You go to the lower time frame and you're only taking trades in that direction. You get stronger momentum, you get better risk rewards on your trades just by doing things just like that, okay? And then there we get the red candle rejection, which we can take. We get red candle rejection just like that. Stop loss, other side of the candle. The reason why I see the other side of the candle, because even though we might have a resistance area like the moving average here, or like horizontal moving average, even though we might have different resistances, the candles itself at that point in time do show the psychology of the activity going on, like the psychology of the actual the psychology of the actual candle going on right now and the people inside. So even though we might have, let's do a resistance like this, price does pop above, and as long as we pop back below, I'm good to take a trade that just goes, I'm good to just take a trade that pops back above, and I put my stop loss on the other side because that's the new high of all of this. Okay. And then basically that's how you go for the moving average and everything like that. You have your general time frame. This is a high price, this is a low price. You go to lower time frame and you're only trading in that direction. You need an idea for I'd say just to focus on entries, get a good risk to reward on trades. So something like this, risk 1 to gain 1.4. Like I said, I try to keep mine to risk 1 to gain 3. If you don't have that much patience for yourself, risk 1 to gain 2. But like I said, you got to get the sample size. You got to get all of that to be able to take into consideration what you want to do. Risk 1 to gain 4, risk 1 to gain anything like that. Okay, kids. Okay, so we have the moving averages that we kind of touch on a little, and just understand that the moving averages produce opportunities at a rate that we would like. That's the main thing for choosing a moving average that we want. Some people are using 15, some people are using more so the people with the longer moving averages can be doing investing, or just want to be aware of the super general trend. Okay, the next thing I want to go into is Fibonacci. It's a really important one, and more so we break away from the natural support and resistance that I go through and I trade, just like that. But we have like some some Fibonacci's, which I'm gonna go through and do this. Moving averages, and then we're going to touch on divergence. Okay, cool. So let's just do this. Moving average, I'm sorry, Fibonacci. Let me make sure my Fibonacci levels are right. The very standard Fibonacci levels, you have 0.237, you have 38, you have 50, which is not necessarily Fibonacci level, but the 50% is a Dow level, Dow theory, if you don't know about that, but that's where the 50% comes from. But we also apply it to Fibonacci trading, and then you have the golden ratio, the 61.8, and then we can cancel off the 1.27. These are just extensions, and they act in the same way. They act in the exact same way. Okay. And then I'm going to add this because a lot of people use this as a take profit area. Just a second. Yes, the probability increases on the higher time frame, but nonetheless, you must be trading in the direction of the major time frame. A lot of the lower time frames is just comprised of a lot of noise, a lot of counter trend things, and a lot of pro trend things. Essentially, you get a lot more whipsaws and things just like that from the lower time frame. But nonetheless, when you do go to the lower time frames, the reason why we're trying to go to lower time frames is to get better risk to reward ratios on our trades, while trading in the direction of the higher trend. Okay, let me find this thing. Yeah, so it's negative 0.27, which a lot of people use for their take profits, which is something you'll be able to do as well. Okay, I want to give a quick explanation for these numbers. Quick explanation for these numbers. Okay, so the 23.7 is more so like an average number. Bruh. Okay, yeah, the 23.7 is more like a low retracement number. So the way this normally works in this case here, let me do both cases. Okay, in this case, we would have the major trend move down, probably already off of lower lows. Okay, and we're expecting lower lows to continue. So as price retraces, if it comes to 23%, it's known to be a very light it's known to be a very light retracement. So with a light retracement, you might just get the main trend to continue through very heavily. Then you have the 38%, which is pretty much a classic reversal. I mean, a classic retracement. And then it's known to be a very golden ratio. It's known as the golden ratio to get a pullback there. And then you also have what's considered double tops. If price comes back up to the 100%, and then could continue down lower. One of my biggest issues with Fibonacci is I realistically don't feel like there is a certain specialty, let's say, to each number, because like I mentioned before in other places, each strategy is going to go through its losing periods. Each strategy is going to go through its losing times. It's not, no one thing is really super special in my opinion. Okay. It's more so just sticking to your plan. So if you're using Fibonacci's, you got to be using your Fibonacci. You can't be Fibonacci today and something else tomorrow and not even acting on them. Okay. So same thing goes here. For uptrend structure, we expect uptrends to be going on already before coming in, and then we look to see a retracement and then continuation. So I believe I'm on a new chart, right? Let me just delete all this. So let's go to the weekly. And I'm starting from the weekly, but you guys don't always have to start from the weekly. You guys can definitely go from daily, 30-minute and downwards. Mainly I stick to the weekly because that's just how I do my thing. I go from week to week. I get my trend from the week. In the case like this, we're getting downtrend structure, as we should be able to see. We're coming off into a very tired zone, I can tell. Basically, with all the bullish wicks coming in, you can tell that price is easing up or trying to go higher. And then we have this area of conflict, and we have this area of conflict. But that's not really what we're touching on. Okay. Okay, so our golden areas. So let's say we have downtrend structure, which we can see. Okay. Let me mark off the start of this, and then I think I might go to some other charts to show some more examples that way. Okay. Yeah, so essentially, you get better entries from the lower time frames, going in trend with the higher, analysis from the higher trends, and then lower trends for also perform your analysis on the lower time frames. But in that case, it's not, other people trade this way, but this is not the way I trade, where you can have, if the main trend is up, I'm really only looking for uptrend trades. I'm not going to do up, get stopped out, and then go look for downtrend trades. There's always going to be uptrend trades. So let me just answer these. So yeah, it should work on all the different markets. Maybe I'll go through and touch on some other ones. There is a private group. There is a private group for the people who got the course, but there are no signals with those. Signals are still being worked on. How do you catch your pullbacks after missing my first entry? How do you catch a pullback on making your first after? How do you catch pullbacks missing first entry? Okay, I think I went through that, but I might have to go through that again. I'm not sure if that was covered neatly. Okay, so here's the thing about Fibonacci's. Okay, swing high to swing low, and then we expect continuations. Every time it's always that the trend should continue. If when we're looking at the moving averages, it's not necessarily like, okay, price is on top of the moving average, so I'm expecting it to go below. At some point in time, sure, because nothing stays on top forever, nothing stays below forever. Okay, but it's still, as price is on top, you expect price to stay on top. Okay, so here's the case where we started swing high, where we got this from the weekly, where we seen downtrend structure, all the way to swing low. Okay, so this is another thing about Fibonacci, why I don't go through and do it all the time. We have some other zones, which let's see if I can place them in. We have the 70 the 78 and we have the 88. Okay, there's so many zones. A lot of people use different zones. This is why I don't feel like any zone particular is really special. Each zone just acts as each zone is to act as a support or resistance in this case, where you look for those rejections. Okay, so when you get the rejection, you have multiple things that you can do. Stop loss other side of the Fibonacci. I've seen many people do it that way, or a stop loss just on the other side of the candle, the entry candle. And in this case, we would get stopped out as there's the wick, and that's about 30 pips. Okay, there's about 30 pips there. And then one thing to take note of is after the retracement, we definitely want to see the old trend kick back in, is where we go through and we track the trend. Okay, there we get our retest of the previous structure, where you then look to take your entry on the red candle rejections. Okay, you need a rejection from these areas, or in a case like this where you're expecting a retest, and this is the same way I showed it in the TPA 2.0. After you're expecting a rejection, stop loss at the swing high, and then TP can be first TP can be the previous structure lows, right? And then because we also expect trends to continue, we have the negative 27. Let me do it like this. Where to go? Hold on. 4 hour. Okay, yeah, so negative 27 is down there. So we have those two areas. Why do we really have those two areas? Is because we expect trends to continue, okay? So if prices, let me draw this in real quick. So we have this formation, cool? And as price pulls back, we expect trends to continue. Our first area of resistance that we should run into is the previous high. But still, nonetheless, we expect these things to continue and form a new high. So our first area of conflict is where we can make our ideas, and this is also still a support and resistance area where we can look to take trades if there's going to be a retest or just a breakout to the upside or from the retest. But nonetheless, they're always going to be to the upside. It's always to the direction of the major trend. And I will probably go back and do the whole thing about the re-entry part, because there are times where you miss trades and you're just looking to take re-entries. But there's a case like this where you have those two TP areas. Okay, 37. Okay, let's go to another chart and do the same thing. Let's go to hold up. I think this will be clean still. Okay, yeah, let's look at this. So we know you have a lot of Fibonacci traders. The way you do this, from low, structure high, move it across, and then we can see that we have a few pullbacks. Our first pullback to this zone here, where does this span from? Okay, this spans way back. This spans back until like 2019, about June 2019, okay? But when we look at the more present day stuff, we can see that we actually pulled back to this area of the 61%, very cleanly actually. Formed bullish candle is where you look to take your trade to the upside. The first area would then be the previous high, which we see that we didn't come into with this. We just continue to consolidate. but nonetheless we came back to this area once again. Okay, if I can just do it like this as well, where we do from swing high to swing low, is the same thing. We get a 61%, and we don't know where we're going to get these pullbacks at, because here we can see our first pullback was at the 61%. We got a red candle rejection, but this would only be for if you're taking trades. You're only looking for this type of like high to low is if you're trying to take trades to the downside in the expectation of in the expectation of downtrend lower low type trading. Okay, yeah, essentially. Let me go through and see one more example so I can do this. Okay, so you have the case like this where higher time frame from the weekly, you go swing low, swing high, and then you have a pullback to the 50%, right, before we get that bullish candle to come in. And then you go to the lower time frame, and then you're replicating the same thing. It's the same thing as when I was doing the support and resistance. We're looking for the higher high trend to come in to take a trade to the upside. Here we don't really get one. We get a pullback down here. Trade fails. Okay, trade fails, so we lose out on that. But nonetheless, that's all we're looking for. We're always looking for. Let me just delete this. It makes it more confusing. We're just looking for pullbacks, stop loss other side of the zone, and then your TP can be 127. That's something I really focused on, that I used, and you probably see a lot of other traders using it like that, to go to the 127 for the TP. Like that's a way I used to go about doing this. So like I know that's a good TP area, and then the other one is structure, the previous structure high, and then the way a lot of you guys seen me in the Telegram for the signals I was giving, I believe it was, is I would leave open-ended take profits so I can maximize profits throughout the week, and then more so towards Friday is when I'm looking to actually close those trades. Okay, so that's kind of what I want to say on check GPY. Okay, good rule of thumb, automatically assume. No, I would definitely not say. So for the question, is it a good rule of thumb to automatically assume that all of the market movers, example, in essence of institutions, are looking for the 61%? No, no, I would definitely not say that. Just because I feel like a lot of institutional traders aren't necessarily trading with the Fibonacci. I don't think any of these zones actually have any key significance that makes it better than anything else in the world. It's more so just to deal with consistency, and these are the tools that you plan to choose to use in your trading. Me, I don't use those. I would just use support and like classic horizontal line support and resistance. But it's like the same thing with the moving average. Your areas of key interest are when price is at that support and resistance of the moving average. So the same thing applies for the Fibonacci. If you only want to be using that golden zone, the 61%, then that's all you're holding yourself to take good risk to reward trades from there. If you want to keep all three on, like a lot of traders do, the 38, let me pull this up real quick. If you want to keep it like a majority of the traders do, with just the 38, the 50, and the 61, you could do that too. But nonetheless, you're looking for rejections at these places. This is the reason why I kind of threw out the Fibonacci out of my not my skill set, but out of my what I use. Like I mentioned in the beginning, removing useless things from the trading, and to me, that's not something I needed to apply. But when I touch on the last aspect, this will make a whole lot more sense. Confluence trading. So let me just go to the last one. Divergence. Okay, so let me pop up an indicator here, RSI, and I'm gonna also pull up the stochastics. These are two indicators let me go. Oh wait, I understand. It seems like a lot of consolidation on that level. Nice trend. Yeah. Okay. So I like that question, and or I like that statement where it's like, I understand. It seems like a lot of the consolidation happens at that level, but this is the thing where you would definitely need a sample size to be able to say, okay, how does price react at this area that I can act on, that I can do you like basically do you want to limit yourself to just these opportunities? Because you need to a lot of people face analysis paralysis where they're not sure what to do at this point in time, or at this point in time. So reduce your outcomes. Like, that's why for me it's more so, okay, price is at support, or yeah, once price gets to support, I'm on alert to say something might happen at this area. And then it's after I get the green candle that I can say, okay, this, I know my stop loss goes on the side of the zone and my take profit is 1 to 3 essentially. Let me just make sure. Good rule of thumb. Check JPY. Crud. I want to okay, so let me go through and do this. I believe my numbers are a little different. Oh no, okay. So for the RSI, okay, the way both of these work, you can see that there's these purple zones. This is middle range. What moving average use? I'm more so a person that would use the 9 moving average, because like it produces opportunities at a rate that I can like use, but mind you that I have a completely open schedule, and I'm not trying to do any investing or anything like that. Yeah, I'm not like, so I'm not looking like to use the 100, the 200 moving average or anything like that. I would stick mine to something, 14, 9. I don't really need to go too far and beyond, or it won't give me trades. It won't give me opportunities to the degree that I would like. Yeah, so here we are on GJ. Yeah, and then I want to touch on these. So these areas in the middle are basically, we can call these are not our area of interest. The only time you really have an area of interest, ideally with these indicators, is when price is above this area. It shows overbought and oversold ultimately overbought and oversold. So it's kind of like stress. So if price is all the way at the top, you expect a fall to happen. Like, let me show it like this. Let's remove drawings. Smaller. Okay, so yeah, so you have a case like this where I believe my sensitivity on this is 514. Okay, so these things are all set at default. 14. Okay, cool. So like I said, once price gets down here for the RSI, you can see price started to go up. The price is in a stressed area. Anytime price is down here, ideally it shouldn't stay down there. It tells you that price doesn't want to be down there. Okay, but that's more so the simplistic way to look at these, and a lot of people still fail just by using this, because as we can see, price often stays down in this area, like over here, where price is down in this area, but price is not necessarily going up. Let's see if I can find some more examples. Here we are above. Now we're above and we fall, but we ideally you get a lot of consolidations and things like that. Ideally, you get a lot of consolidations and things just like that, and there's no, like, this is a good example where price is above for these RSI and stochastic, but price is not falling. Okay, so that's one way to look at this, but it ideally tells you that that it's looking to fall at one point in time. Okay, and it just keeps building up. The other way to look at this is, which I find to be more informational, way more detail, is that there's an imbalance. Okay, so ideally price and these indicators, the RSI and the stochastic, should be following the price. Okay, so any swing highs, any time price goes like this, the stochastic, the RSI should also be making the same thing. Okay, so the times that it doesn't do this tells you that there is a divergence in the system. Basically price, the average people, the people moving the price, sorry, the RS, sorry, hold on. Okay, so you have like, let's go to show a divergence in this. Okay, so you have, let's say, a double top, right? Price slightly goes above. Okay, here you have price slightly go below. So this is divergence. It tells me that something is different between the price and what the actual banks, what the actual market movers are doing in the market. Okay, let's see if we can find some other ones. We have another one right here where we go, sorry, wrong tool, where we make a new low and price here doesn't make a new low, it makes a new high. So it tells me that there's an imbalance in the situation. Okay, same thing for this one down here. We actually do go according to suit. We do make a new low just like we did here. And in this case, when you're using divergences, you don't really have to use the backgrounds or the upper and the lower bands, because you're not looking for stressed areas in this case. You're just looking for inconsistencies between the buyers and the sellers. Okay, I used to trade like this, and I really do prefer trading like this too. It's really I believe it provides a lot of good opportunities, just for finding the imbalance when things don't make sense. Like here we have a push up, and here we have a push down. Here we also have another push up. So it seems more so that the stochastic, the bottom one, the bottom indicator, goes more in suit with price. But here we have the RSI, which points out more differences between the two. But here we have, when things are in trend, we have a high to a low. We also have a high to a low. Okay, and then ideally when you're taking trades on this is candle close. Okay, candle close, and then we're still focusing on risk 1 to gain 3, risk 1 to gain 2, whatever you want to hold yourself to. Whatever you want to hold yourself to, but you're looking for these inconsistencies in the market, and you apply these to your plan. Okay, so when you're going through, let me just write this down real quick because I want to go back and touch on this. I want to touch on like you need to apply these things to your plan, these different type of entries that we're looking for. Even if you want to take entries based on unclosed candles, you're waiting for, like, let's say, let's do it like this. Let's do it like this. Okay, so yeah, okay. So here we have like a structure, which I'm gonna highlight like this, and we can highlight this like this. So just given this fact that price dropped here, but went up here, tells me that there's a divergence. There's a good chance that price is gonna look to go down, but we actually popped up for a double top. But nonetheless, the divergence is still there. Okay, there's even more so divergence here as well. These divergences are everywhere on a bunch of time frames. You got to just find them and act on them, applying them with the next thing that we're going to touch on, which is Confluence Trading. You see a lot of traders do this. You see a lot of traders have multiple indicators on their charts. So moving averages, support and resistance. The way that I used to go about doing it, I'll show exactly that. Actually, let me just do it exactly like that. And basically, this is the last part that I want to be able to touch on, and then I'm gonna do one more thing, which refer to how to apply this to like a plan. Okay. Let me just add some indicators. weekly. So the way I used to go about doing this would just be to apply the moving average. Also be using Fibonacci, using trend lines, and using support and resist, using horizontal line support and resistance. Ideally, I dropped a lot of these things just to use support and resistance because I find it still works. But you have those cases where ideally you have what's called confluence trading. So you're applying multiple things, and I would say use when two of three at least of these things apply together. Maybe you do, okay, bet. Let me do that. Let me do that after the replay thing. Okay, just a moment. Plan, replay. Okay, cool. Yeah, so let me just go through and finish explaining this part, and then we'll try to do the replay. Yeah, and no, the trading course does not come with any signals, not anything like that. It's strictly just information. Really rough. Yeah, so same thing goes, top-down analysis. You start from the higher time frame. You would go from like weekly, daily, 4-hour to your entry time frame, and go through and apply all these things. So you apply your resistances, you apply your supports, apply your resistances, you apply your supports, you get your general trend so you know which way you're looking to trade in the market. Here is a good opportunity with double bottom occurring there, and we also have a trend line already striking up. But in this case, let's go from swing low to swing high. I'm gonna actually take off these zones and just keep with the classic 38, 50, and 61. And then you pop down to the lower time frame, and basically you just need everything to be in trend, like in a case like this, or let me see if I can see the number. Okay, so this is the idea of confluence trading, because we have multiple things stacked in this area. We have the 38, we also have the 50, and then we also have this resistance turn support, and then we also have this this trend line that was broken through a few times, but we came back and rejected it. Ideally, let me go to some other charts and show the same thing. It's confluence trading. It's just having multiple indicators going in the same direction. And like I said, I dropped it because I find I want my trading to be more simple for myself, and I find these things to just be, they're not necessarily needed. There's just something that if they're a part of your plan, you must apply them. As long, like, you must always just be going according to your plan. And we talked about those things in trading plan, what a plan consists of. But let me do the replay on this actually. Shoot, let me crud. Just a moment, let me set this up real quick. Let's go GJ. Like this. Oh crap, my bad. Oh, this is gonna take too long to do. Okay, yeah, so the idea is confluence trading. So we're applying those things like different you're applying different things like moving averages, Fibonacci, horizontal support and resistance. Yeah, and then you're always trading in the direction of the trend. And then there was trend lines as well. Okay, so here we have a case, weekly time frame. We're making higher highs. Always look left, trade right. There you got a resistance. Got some of these. we have a very strong up move here. This is not a trend line. This is not a trend line that I'm drawing. I'm simply just getting the main thing. And then we have we can use this as a trend line because we're not breaking through any bodies and we're staying in contact with the wicks, okay? So that is something we can leave. Let's look and see if we have any Fibonacci forming here. Low to high, we use our current high. Obviously that's the information that we can work with. And then I personally go through and apply some of these basically period separators, essentially. And then you go down to the forward time frame where you're looking to take your trade from. If I can find where this is at. Where'd the price go, bro? Oh, my bad, my mistake. I have to just do this on another chart. Hold up a second. Crud, hold on a second. I need to I just need not to go back so far back in time for this to be effective. Let's go to this chart. Let's go replay. And let's just go there. Let's just do that. Okay, cool. Yeah, so we're applying a few different things. At this point in time, we are sitting on the we're below the moving average. We draw support and resistance in. And we're currently forming lower lows. Got this strong zone here. Do we have any trend lines? Let's see what Fibonacci is saying. Structure low, structure low. So it looks like we might, this is looking to be a key area, the 38, because we have multiple things. The moving average is just right there, with all these things basically there. And this is the weekly time frame. We're coming off of a downtrend, okay? So let's pop to the 4 hour and see if we see any other things. Not in any key areas. Let's see how we deal with this support and resistance area. We go like this. So it looks like we're staying below a little. Trend line. That's below. If we can get a rejection of this moving average. So this is one of the ideas of Confluence Trading, that there's multiple things stacked here, the moving average and the trend line in this case, and you get a rejection of it, and then you would look to take a good risk to reward trade. Stop loss on the other side of the zone. In this case, you do the moving average because the moving average and the trend line is there, and then you do risk 1 to gain 3, risk 1 to gain 2, whatever is a part of your plan, and that's ultimately like what you're trying to do. In this case, we hit the stop loss, and we pop back above. So there's a few things out of trend. This time frame and the weekly time frame are currently out of trend. You need the lower time frame to go back into trend. So I'm taking too long on this. Yeah, okay. let's just keep going through this, okay? So here we are at the 50%. Let's go and see. We're also making another push, so we got higher high structure here. And this is one thing as well why I stopped doing this, is because it makes the chart too confusing after a while, right? Makes the chart too confusing, and we are pushing above. Let's see how we can close. Let's just go through and see. Sorry about that. Let's go to the end of the week real quick. Okay, so we closed above this area, showing the old trend could be kicking back in. We popped back above the support and resistance is what we're looking for. The key, one of the key factors in this case. And then let's just it's precisely why I continue to like to keep my charts cleaner rather than like this. But ideally, if we can get a pullback to the support, right? We're looking to take trends higher. Let's see. But you're always still applying Fibonacci and things like that. Fibonacci 38. Okay, well, in this case, we don't get a full pullback. We probably get about a 23% pullback, 23% pullback before price continues onwards. And like I said, you're looking for 2 or more of these things. So Fibonacci, horizontal support and resistance, trend line, and then you have, when I used to do this as well, I was applying okay, hold on. I'm just gonna go through I feel like I'm losing track of time. Hold on. Okay, yeah, so that's basically Confluence. The idea of applying more than one thing, because a lot of traders are already using moving averages, already using Fibonacci, already using trend lines and different things just like that. The idea is to apply 2 or more of these things at once when they both set themselves up with the confirmation of the candlesticks, okay? The candlesticks is just not something you leave out unless you already have a set risk reward. And all of this falls back on just taking good risk to reward ratios on all of your trades. So let me see if I can see one that I have set up already. Okay, cool. Yeah, this, taking good risk to rewards on your trades, or you're gonna get the short end of the stick in the long run. Okay, so I want to go to applying this to your plan. I'm going to go to apply this to your plan, where you basically need to have that idea where, okay, am I using just the horizontal support and resistance as my area of opportunity, my key area, and I'm using bullish candles, bearish candles. I'm considering the higher trend to trade in direction of that. Price action and all that is definitely included, and then multiple time frame is included in that. Those are essential parts, just to have the general trend and go in direction of, and just to go in the direction of the major trend and use the lower trend, go in that direction, and you're taking good risk to rewards. No matter, like, if we're trading the moving average and we're in uptrend in these cases here, all these, no matter what, are bullish trades where you take above the moving average. You let your stop loss get hit in a case like that, and then you have another one where price is up, price on the opposite side of the moving average because you don't expect the moving average to break, and then you try to go in the direction of the major trend. Okay, and then so same thing applies for moving average, Same thing applies for Fibonacci. If we're on an uptrend, all the trades we're looking to take, like this one, hold on, let me do one at a time. Like this one here, you get a pullback to the 61%. This is a Confluence setup here. Moving average gets rejected by the bearish bullish candle. We also get the moving average rejected by a bearish bullish candle. I believe we have another one right here. If this moving average, if this thing connects. Okay, so here we have touch one, touch two, touch three of the trend line. Okay, here's the same thing with the Confluence. Structure low to structure high, move it over to the right. We get a rejection of the 50%. We get a rejection of the trend line. We also get bullish candle to come in, and then we have this bullish candle which closes above the moving averages, which signals you that you can take this trade, risk 1 to gain 2, risk 1 to gain 3, whatever you want. Or like I said, when I was using the Fibonacci more, we would try to take profits at this area here. And then you manage your trade. And then also, one thing we also covered in this is that you have the next area of resistance. But once you hit that area of resistance, it doesn't mean to like get out of the market, or it doesn't mean to get scared at this point in time. It simply means that this is an area where something may occur. The price may try to reverse at this point, but you're still keeping in mind the higher trend analysis. You're still keeping in mind the grander scheme of things. And I'm willing to be wrong going in the scheme of the grander things. Like when I talk about the river, like a majority of the river is going downhill. Not all of its waves are downhill. And I might be catching one of those waves that aren't downhill, but every other one that I take is going downhill. And then I want to touch on, so I could stay on this and talk all day, but that's not really the objective here. But let's try to do something like this, where we have a ranging zone, prices ranging between this, and then you have, let's say, a setup right here that you miss. Okay, you enter a trade, or you miss the whole trade setup, so you don't get to take it. You just continue to track price, so you get another one. Price is all the way down here. This is not a viable entry because at this point in time, this support is now resistance. But when you do pop back above, you can try to get a good risk to reward on your trades. Risk 1 to gain 2, risk 1 to gain 3, risk 1 to gain 10, whatever you want to hold yourself with, but you need to know the return rate of each individual trade, so then you can be like, okay, I know I can be risking 1 to gain 2 on my trades and still get a profit in the long run, out of 10 trades or out of 100 trades, basically just like that. I'm gonna go through the trades, and then basically let's try to do like one quick set of like replay. If I can change the line. Where's the line at? Where's the line? Line. I swear the line is like right here or something. Cross here. Watermarks. I'm trying to find where's the line. Right now the line is set at blue. Line is set at blue. I don't know. But anyways, let's just go through and do one quick one of those, and then I'm just gonna go through and do answer some of your questions. Let's just hop onto this random chart. Let's go back. Let's use this. Let's go like that. This is 2014. Okay, cool. So we can like start in this area. But I do the same thing. You got to know your trading plan inside and out. Okay. Price is forming some higher high. We are coming out of a consolidation area. we have this. We have this. And then we have some very minor zones down here, which we'll look on the lower time frame and see how those look. Then we have that support. That's all that's really that's all that's really relevant. And then we have this. Okay, so price at this point in time, I'm on alert to take a trade simply because price is at this area. But I'm not looking to short simply because I know that the trend is up. I'm looking to just take trades in that direction. Okay, let me do this other thing where I mark this off. Right, just as period separators, because I know I do my analysis week by week. So by the end of the week, I'm looking to update my analysis basically. Same thing goes. I'd like a pullback to one of these areas to take a trade. Ideally, right? If I can get a pullback to one of these areas, we can take a nice trade. Same thing goes for these moving averages. You're just looking to take a trade based on those. And this is a good case where you have a rejection of that major support from the weekly, stop loss other side, and TP to the next. And there you have a loss. Same thing goes. We come back to the what do you call it? The support. Come back to the support, and it's the same bias, it's the same everything that you're looking for. Always stop loss on the other side of the zone, and then you would just try to let it run through. Okay, and you manage your trade as you're going, and by the week's end, you look to adjust your trade, adjust whatever you got to do. Let me see the weekly real quick. So weekly is struggling, but we are staying on top, so I'll give it that. Same thing applies. If I can find a area for price to pull back to, is the same thing that you're looking for. Like a bullish trade, and you can do risk 1 to gain 3, stop loss at the low, and the TP just above. So like I mentioned in multiple videos, multiple places, everywhere, you have risk reward. You have these trades that you could take. Okay, weekly close back below. So now that the weekly is below, it looks like it does want to reject this area. Let's see how much trades did we take. We took 1, 2, 3. So opposite thing applies basically. If we could just get a pullback. If we get a pullback to the resistance, is when you look to take your trades. And I'm not applying the Confluence. I'm not applying anything like that, simply because that's not the case all the time. Okay, 1, 2, 3, 4. Okay, so this is a good example. We won this one, lost this one, lost this one, won this one. And from price hits its support area, then you reanalyze, you reassess, reanalyze the opportunity ultimately, because the play has finished, the move has finished. Even if we didn't get an entry opportunity, but the target area still gets hit, it still cause for reassessment of the situation. And then, like I said, I would reassess my situation every week. Different traders, you go day by day by day, and do it basically just like that. In this case here, risk 1 to gain 3. If you're losing 2%, in a case like risk 1 to gain 3, you're winning 6%. So you lost 2%, lost 4%. This puts you +2, and then this one calls, let's say +1. So I think that's +3. So you got to think of it sum by sum. It's not a trade by trade experience. You can't judge them trade by trade. They got to be sum by sum, ideally. Okay. So I'm gonna wrap this up. I've been on here for like two and a half hours or something like that, almost 2.5 hours. Yeah, so let me just see if you guys ask some questions, and then I'll just go through and do anything like that. Try to just answer any questions. So Fib is a good tool to have in your arsenal. Identify the behaviors at certain levels, which is very true. One thing I want to say this because I want to refer it back to the PDF course, which I know a lot of you guys have read. So basically, we have the Fibonacci, we have those major levels of 38 to 50 and the 61%. All of these areas are places that we can look for trades from. It's really to know your trading plan, to say, okay, when price gets here, this is my limited opportunity. This is where I will either do this, I'll place my stop loss here, and if like for this case where I gave here, where my stop loss did get hit, and it's just up to you to continue going and just take the next setup. This produced about one trade a week. This produce about one trade a week, and sometimes I get like 2 or 3. Sometimes it's a whole like multiple charts will lose at the same time and things just like that. But you need to be able to keep a balance that you can keep going on through. Okay. Does the course come with signals? No, it doesn't come with any signals, or it's just straight information, and I'm there to assist you with your trading, and I'm there to assist you with any with anything trading related, like all cause basically. It's hard to spot the divergence live. Cool, hold up, let me do this one other time. Let's do it like, it's only gonna take 1 minute. Let's just do let's do this. Actually, crud, this is probably not the best example. I can't get these lines to be the way I would like. I would like them to be invisible, so I really don't know what's coming next. But I'm not sure right now how to obtain that. So here we have a case. Let's just keep going through actually and see if we can get another one. Here we get some divergences, but we also need to be at an area of key interest to take these trades. So we have a support down here. Let's see if we can form something down here. We have this, something like this. Actually, okay, hold on. Let's see what else we got. There we pull in. There we have a little bit of a divergence where we have a low here and we actually have a move up. So let's see if we can take a trade. Let's get a bullish candle. Take a bullish candle up. Let's do risk 1 to gain 3. Stop loss other side of the zone. Risk 1 to gain 3. Something like just like that. Okay, so in that case it's a loss. That case it's a loss, and we don't have another divergence. One thing that I did miss from this, which I will say, is like you still need to apply the top-down analysis. You still need to have the. I honestly went through and did this the wrong approach, but you need to have the higher time frame and apply all those into your things. Same way I did it for the Australian with the support and resistance. The way I go through that. The moving averages. I personally use the 9. I like the speed which that goes, but I'll say it again, and you guys will have this to look for. You guys will have this to look for in the videos. I'll keep this posted. You have the longer lengths moving averages are necessarily for longer period trends, like investors or people that just want to know the super general trend. Can keep that and keep those 200, the 50, the 100 moving average, and basically these things, the moving averages only produce opportunities at a certain rate. You want your trading plan to fit you. You want them to produce opportunities that basically at a rate that you can work with. You don't want to be using a two period moving average, if it's producing way too many opportunities. If it's producing like 7 opportunities, 8 opportunities a day per chart, you won't be able to make a move on all those. So you might need to slow it down a bit, and you'll probably also realize that every other trade is not of quality. They're just basically not of quality trades, okay? And then you said for scalping, can I use the higher time frame, or is it better to use the lower time frame? So I would say better to use the higher time frame. I do know one student who's using he's basically doing his analysis from he's getting his perspectives from the daily, the 4 hour, the daily 4 hour, then 30 minutes, and then he would go to take his entries more so from the 15, 30, and sometimes 5 minutes if the market is that volatile. But the same case goes. General trend for your information, like let me do this. Let me go do this and do this. We are in this is the same market I was just doing, right? Let's see what the weekly is saying. Yeah, so we're in an uptrend in this case. Okay. Same thing goes if I were to go to the 1 minute time frame, or let's go to the 5 minute time frame. I'm still just gonna look for uptrend market structure opportunities in the same exact fashion. Here we have a long wick. Let me delete this. Here we have a very long wick. And in this case, like I mentioned before, I don't normally use those long wicks, but this is the 5 minute time frame. So this long wick is actually just, that's 7 pips. So it's not a big deal, right? Here's a case where we can make a move on this. It's a pretty wide zone. Stop loss like that. Risk 1 to gain 3. Let's just do it like that. And no matter what, no matter through the ups and downs, you just keep it going. Hold up, let's see. So look at that, very, very close to take profit. What would you do? These are when your fears come into place. These are when if your trading isn't deep in your subconscious mind, this is where you stop relying on the subconscious, because your conscious brain is what analyzes stuff, your conscious brain is what tells you right and wrong. It analyzes, okay, this is blue, this is this. But your subconscious mind just acts. It just believes in what is going on. So, you just got to keep holding through, and because you believe in your plan. No matter if you hit your stop loss, great. We hit our stop loss in this case. Same thing goes. We're just looking for uptrend structure to be there to take our trade. So let's say if we can pop above this. And this is the case I was explaining in the beginning, where I already know that I plan to take a trade on this, and I kind of already know what my risk to reward ratio is going to be. So I can place a pending order like this without the candlestick confirmation, because I don't have a bullish candlestick confirmation yet. Put my stop loss other side of the zone already. Take profit 1 to 3, and then you can play and see if you will get hit into the market. In this case, you don't even get hit in, but we'll see. We'll see if we ended up pulling back or whatever the case is. Okay, but essentially that's what I'm going at. Same thing. You're always looking for those pullbacks and the retests. That's all I really want to say for this video, for this webinar. Do I have any other questions that I can ask for? Yeah, but for scalping, you would go down to the lower time frames, essentially. But you still need to consider the higher time frame. Okay, so I'm just gonna close this out now, guys. We've been here for 2.5 hours. I hope I was able to give some value. I hope I'll be able to give some value at least. Thank you for tuning in, guys. Let me just do this right. So thank you for tuning in. This here will be for everyone. I'll keep this posted, and I'll try to break this down into details where I talked about these indicators in detail. So just like focusing on the moving averages, and you have one that's focusing on the Fibonacci. I'll whip that up and I'll put that out for you guys. Yeah, so dividing them into specific topics for easier and more direct access.